Any further trade deals between America and the rest of the world as we pass the 1st of August deadline and the Bank of England's latest monetary policy decision on the 7th are likely to dominate the macroeconomic headlines in the coming week, when we will also have yet another very busy slate of corporate results here in the UK, as well as Europe and America. Another 11 members of the FTSE 100 will report full year or first half results in the week ahead, and they are Diageo, BP, Smith & Nephew and Fresnillo on the 5th, Glencore, Coca-Cola Euro Partners, Legal & General and Coca-Cola Hellenic Bottling on the 6th, and Intercontinental Hotels, WPP and Hikma on the 7th. Now that's quite a diverse group in terms of addressable industries and business models, so we're going to focus on just 3 of those names. And they're 3 of the worst performers within the FTSE 100 in the year to date in share price terms, and all 3 management teams are under pressure from shareholders to do something about it and turn things around. They are WPP, single worst performer in the FTSE 100 after a near 50% plunge this year, where Mark Reed will be replaced as Chief Executive by Cindy Rose in September. Diageo ranks 97th after a fall of nearly a quarter, where Deborah Crew has just quit as CEO and Chief Financial Officer Nick Jangiani has stepped up on an interim basis. And BP ranked 69th, where Albert Manifold will become chair on the 1st of October and work alongside embattled boss Murray Auchincloss. Now, to take them in chronological order, Diageo's first up on the 5th, with its full year results to the end of June. The drinks giant, whose key brands include Johnnie Walker, Captain Morgan, Smirnoff and Guinness, stuck to its prior guidance for 2025 and 2026 alongside May's trading update, and that steer will provide the benchmark for these numbers. For this year, analysts expect a 1.4% organic sales growth rate and a headline revenue number of $20.2 billion, flat on last year and in keeping with management guidance of a better rate of organic sales growth in the second half than the first half's 1%. For 2026, analysts expect an acceleration to 1.8% growth, reported sales of $20.7 billion. For adjusted operating profit, management had predicted a slight drop, similar to the 1% rate of decline in the first half. And on a reported basis, analysts expect $5.7 billion for the year just ended, compared to $6 billion, and $5.9 billion for the year just begun, where management's previously stated operating profit should rise faster than sales. Shareholders will look for comments on price and volume, any impact from tariffs, and also for geographic trends in the business, where Latin America in particular has continued to perform badly. Acting boss Nick Giangani will also offer more detailed comment perhaps on the planned Accelerate turnaround programme. Meantime, the dividend is expected to rise very slightly from last year's $1.03 a share, but in sterling terms that's likely to equate to a drop owing to the pound's gains against the dollar over the past 12 months. Diageo is not currently running a share buyback either, and analysts will look for improved cash flow, comment on the $20 billion debt pile and what management intends to do about it, given ongoing speculation about assets disposals, possibly quite substantial ones. BP's first half results are due on the same day, Tuesday the 5th. It's early days for BP's refined strategy, as the company puts more emphasis on getting value from its existing hydrocarbon assets, but weaker prices for oil and natural gas aren't helping sentiment. The first quarter numbers were nothing flash, as cash flow was weak and refining margins showed pressure within the customers and products unit, while the second quarter update early this month wasn't particularly hot either. On a headline basis, the key figure will be replacement cost pre-tax profit, where the consensus analyst forecast is $4.6 billion, an improvement actually on the first quarter's $4.2 billion and the $2.6 billion outturn in the same 3-month period last year. Attention will then switch to the divisional performance, as well as cash flow and the balance sheet, where net debt has started to move up once more. Shareholders will also want an update on the asset disposal plan, especially with regard to Castrol, before they look toward cash returns. BP paid an unchanged quarterly dividend of 8 cents a share in the first quarter, but guided to a lower buyback for the second period of $750 million. Any guidance for any buybacks for the third quarter and beyond could be instructive. Finally, we come to WPP. The media and advertising giant coughed up a profit warning in June and quickly accelerated its chief executive succession plan as shareholders wondered whether the problems were the results of cyclical challenges and a soft economy or structural ones in the form of AI or indeed a mixture of both. Either way, WPP warned that first half like-for-like sales would drop by between 4.2 and 4.5% for the year-on-year, and it also lowered full-year guidance to a drop of 3 to 5%. First half operating profit was steered down to between £400 and £425 million, thanks to lower sales and also more redundancy costs. But the real key may be on the full year, where management's current forecast is for a drop in adjusted profit margin of around 0.5 to 1.75 percentage points, down from 15% last year thanks to lower revenues and investment in the WPP Open Platform and Open Intelligence. A cut in the dividend is seen by analysts as a risk for the full year. The interim payment last year was 15p and the total 2024 payment was 39.4 pence, and WPP last ran a buyback in 2022. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.